Afsaneh, let's start with you. You are a longer-term investor. You take a longer-term view. Historically, we've thought that a return for a pension plan, for a foundation, would be about 5%, a real return. In this day and age, given the risks we're looking at and the incredibly low yields, is that realistic, or has that number got to come down a fair amount?
Using the same risk factors as the past, I think it's going to be much harder to get that 5%, David. But I think what you're seeing is a lot of revisionist sort of work right now, where a lot of people are looking at the traditional 60-40 portfolios and seeing that those will definitely not get you the 5% return. And it's that 40% bond allocation, which is the big problem, of course, if rates stay at zero for a long time, as we all expect, that then you have to take new kinds of risks. So one thing that you're seeing is people taking more credit risk in terms of that bond portfolio. And within equities, what you can do is start holding your companies longer. One model is the private equity model, but that almost is getting to be old. And a lot of people are looking at holding companies for a very long time, private or public companies, rather than churning them, because that reduces a lot of costs. And if a company is really good, why churn it? So what you're going to see is, I think, really moving closer to maybe an 80-20. Some people are even talking about a 90-10 portfolio. And then within that, really making changes. The other thing that is happening is, of course, passive equities and passive bond portfolios and ETFs have become a large part of big portfolios, pensions, and endowment foundations. And what you are going to see probably is that active is going to be coming in a much bigger way. Just look at what happened with S&P 500. If you had invested in the top 5, you'd be up more than 20%. And if you had invested in the other 495, you'll be down a couple of percentages. So passive investing may be going out in the way it was done in the past. And I think some form of mix of passive and active might be there.
So Larry, what is your take on this? I mean, what is a realistic, real return? And by the way, if we really do have to give up on essentially the 60-40 hedge against equities going down because the yields are just not there for bonds, what does that do to the economy?
David, I agree with what Afsaneh said, but I think I'd be a bit more pessimistic than she is. I'd put it this way: relative to 20 years ago, real yields on Treasury instruments are down 3 to 4 percentage points. That's kind of the base in the financial system. And then the question would be, what's happened to the risk premium that you can get by investing in stocks or by investing in risky companies? I'm not sure that risk premium has moved a lot one way or the other. On the one hand, you could say that maybe that the risk premium has gone up. On the other hand, the fact that there are a lot more people who are happy to take a lot more risks would, other things equal, tend to drive the risk premium down. It was much easier for sophisticated investors like Afsaneh, like the Harvard University endowment, like some cutting-edge pension funds, to find alternative managers in private equity or in hedge funds 20 years ago than it is today. Those spaces are crowded. So I would argue base safe rate down three percentage points or more. Risk premium probably hasn't changed a lot. Capacity to generate extraordinary returns through manager selection or through picking the best assets, that's probably diminished substantially as it's gotten more competitive. And so you add all that up, and I think institutions will be doing fine if they average inflation +3 over the next 2 decades. I don't think that's been internalized by the world of pensions. I don't think that's been internalized by the world of nonprofits. And as it comes to be internalized, I think it's going to be a pretty serious economic problem, because they're going to feel a need to save more, and that's going to be a contractionary force bearing on the economy. I also think they're going to get driven into a riskier set of assets And when they're in a riskier set of assets, that's going to be fine as long as things are good. Right. But it's going to up the pressure for Fed bailouts when things get difficult. And that's not a game that can go on forever. So I think we're looking at a much more problematic long-term financial situation than is generally supposed, with more risks of disappointment and more risks of increased risk-taking that leads in turn to various kinds of problems and crises.
All right. Afsaneh, if you're an investor and you need to find some yield, what does that do about emerging markets as a practical matter? I'm very mindful of the fact the U.S. dollar has been down this week. We've got, as Larry alluded to, we've got the U.S., the real yield on the U.S. 10-year Treasury well into negative territory, which is driving people toward EM. Is that a reasonable alternative?
You know, I think I agree with everything Larry said. I think before I jump into emerging markets, I would say that the only other place where you can also find returns is not just your traditional talent, but finding new talent, because new talent is looking for different kinds of alpha in the market. And one of the things that we continuously do is find that, you know, sort of the next Sequoia or the next Andreessen Horowitz or the next Baupost or whatever. So in terms of talent, I think you can be on a quest and find people who are looking for the best ideas, but obviously you can't do that if you are, you know, looking for a huge amount of alpha. The other thing I think with emerging markets is that, David, it's a tale of two cities. You know, technically China is emerging markets. Technically a lot of North Asia is emerging markets. But if we look at the huge developments that they are making right in front of our eyes, you know, in terms of COVID, they're ahead in dealing with tracing, dealing with testing, dealing with distancing and all of the other things, which has allowed their economy to take a much faster route to normalcy compared to ours. Similarly, they have introduced into their financial system much better tools in terms of fintech, and can, for example, when the governments were trying to push money into the average consumer, they could push it to people. In our case, look at how inconvenient and how not very good was the PPP in terms of getting to the end user of PPP, because it was being done through banks who did not necessarily help the smallest businesses in the US. So we are basically very positive when it comes to North Asia. And at the same time, when you look at emerging markets as a totality, what we're really worried about is places like Latin America, places like Africa that have made incredible development and where they have had very interesting markets could lose a lot of what they've basically made in the last 20 years. And that could be a huge problem. I don't know what Larry thinks about emerging markets or whether he has a different view.
Larry?
I think Afsaneh is enormously thoughtful on this, and so I hesitate to disagree with anything she says. I think it's a complicated story in China. I think given the vexed political relations between our two countries, any American investor in China and in Chinese companies has to think about the fact that it may well be easier to move money in than to ultimately take money out if you have been successful. So I think a substantial risk premium has to be attached to investments in China for foreigners, and they may work out and they may be worth that risk premium. But I think anybody who thinks that that's easy money is making a very substantial mistake. And I suspect Afsaneh would agree with me that that's not a strategy for amateurs. You know, Afsaneh talked about there are always new managers and there are always new frontiers. Yes, there are. I just think the supply of money looking for those new managers is pretty large relative to the flow of new talent with new ideas. And so I'd be surprised if that was going to work miracles for large pools.